Hey, this is Michael. Welcome to Basic Options 5, Part 4, Moving Averages. So moving averages are probably my favorite indicator. They're the most basic. They're on every charting platform, and I rarely will look at a chart that doesn't have moving averages on it. The main reason why it's one of my favorites, and any successful trader will use them in their analysis, is that the moving averages represent the average price that traders have been willing to pay over a period of time. So it can really help us or help tell us the strength of the trend. So without further ado, let's get right to the definition of a moving average. According to Google, simple moving average is basically adding the recent close of the price and then dividing that by the number of time periods. So if you have a 50-period moving average, you're going to add up the last 50 closes, add them all up, and then divide by 50. And that allows you to then plot on your chart a line, which is considered the moving average. Now, simple moving average gives equal weight over the course of time. There's another moving average called the exponential moving average, and that gives more weight to recent prices. So if you really want to see price action over a short period of time, the EMA or exponential moving average is better. When you want to look more broadly at the market to see if you can identify a mature trend, then you want to look at the simple 50, 100, and 200. So let's take a look at a chart. So this is a chart of Apple. The 50-day I've got here in kind of a magenta, purple, then kind of a turquoise is the 100-day, and in white, which is a little thicker, so I can see the difference, that's the 200-day. 50, 100, and 200. These are broad moving averages, and it's weighted equally. So again, the 50-day moving average is the last 50 days, the closing prices of the last 50 days, all added up, and then divided by 50, and plotted each day into a line. So this is the 50-day moving average, the 100-day, and the 200. So a mature trend typically is identified when price is above those three broad moving averages. Now, what we identified as a trend in a prior video was when a stock makes a higher high, higher low, higher high, higher low, higher high. So higher highs and higher lows, and the price is above those broad moving averages. So we've now added to our initial definition. So an uptrend is identified when price is trading above the broad moving averages and is making higher highs and higher lows. So this is an uptrend. And what you will find is when a downtrend begins, you'll normally see these broad moving averages will cross and it'll start heading downward. Okay? And usually a stock will continue higher when prices are consistently above. As you can see what's happening here with Apple, all the way from August, you've got the three moving averages are stacked, meaning the 50-day is on top of the 100 is on top of the 200, and price is above all three. And look what it's doing. This is considered an uptrend. You don't want to fight the trend. In other words, if this chart is bullish, which it is, then don't look for a short setup. And conversely, if stock is moving in a downward trend, like Apple was from this point forward, look at this movement. This is clearly a downward trend. You can see that the price starts trading below the moving averages, and you have a cross. You have the lower cross, which is the 50 and the 100, and then it crosses the 200, and it just keeps going. Again, don't fight the trend. If the trend is bearish, then do not try to look for a long setup in Apple. And the moving averages can really give you a really clear indication of trend. Now, you can also scan for stocks based on moving average. In other words, how can I find stocks that are trading above the broad moving averages. So that'll give me a good stock pick. So you can go to different charting services. FinViz is pretty easy. So here's a stock screener, and I put trading above the 50-day simple and above the 200 simple. But just because it pulls up a bunch of stocks that are trading above the broad moving averages, you still need a visual inspection, and that will kind of narrow it down. You have to be able to narrow it down. So let's look at here, advanced auto parts. Okay, it was up 1.5 points. Looks good, trading above the broad moving averages. And if you take a look at it, look at this. This is not really a chart that I would be interested in trading. Okay, it had pretty much a downward move from April. It's been going down. It crossed over all the broad moving averages. It has started to come back. It came back to the 200, but it failed and did not break through the resistance at about 170. You can see right here, there's resistance at 170, both here and here. 170 is a psychological value because of the round number. It started to come up, but didn't quite make 170 and failed. It is starting to come back a little bit, but it's trading right at about the 200 moving day average. So this is really not a healthy chart to be trading. So yes, it's trading above the broad moving averages, but on visual inspection, you can see that this is really not a ticker that you want to trade. So another thing that you can take a look at, which I think is really important, are the exponential moving averages. So the exponential, as I said, different from simple moving averages, just that they give more weight to more recent price. So they're a little bit more accurate on the short term. So what I've put here are 5 moving averages based on the Fibonacci sequence. So I have the 8-day moving average here in red. I have the 21-day in blue. Aqua is the 34. Yellow is the 55. And magenta is the 89. So you have the 8, 21, 34, 55, and 89. And what you'll notice in this chart pattern of Roku, this is a daily chart of Roku, notice how these are stacked one on top of each other. In other words, the 8 is over the 21, which is over the 34, which is over the 55, which is over the 89. They are stacked positive, and price is above the 8. And look how it just hugs that 8. It does start to break down, and you'll notice it crosses here. The 8 crosses over the 21. Price moves below the 21, and that begins downward movement. Okay, so what I'm trying to say here is that the moving average does tell us the strength of the trend. When it holds the 8 like it does here, that's a very strong trend. You want to stay in the trade while it's trading above the 8. If it holds the 21, which is the blue one here, that's still a strong trend. And it's considered the mean, which we'll go over again. We've covered that in a prior video. But if 21 is the mean, that's still considered a strong trend. So you can stay in the trade if it's trading above the 21. But as soon as it breaks the 21, that opens the door to the 34, which you can see it did right here. Boom, it broke through the 34, which opens the door to the 55. Boom, broke through that, which opens the door to the 89. And now look how this red moving average crosses over them all. So you're out of this trade. I mean, as soon as this starts to trade below the 21, you're out here. You're out. You don't hold on through all of this. So that's what's really great about the moving averages. As long as you're trading above the 8 and they're stacked, you stay in the trend. As soon as it breaks the 8, you might want to take a closer look at maybe getting out or possibly even adding to the trade, depending. And then if it breaks and has a couple of closes below the 21, you have a close here, but then it starts to break down here. So not only does this thing close below the 21, it closes below the 34. You're out. You're out here. So you made your money from here all the way up through here. It pulled back a little bit and you got out. And you can see that as this crosses over, price starts moving down. So again, if the moving averages are stacked positive and trading above the 8, you're going to stay in the trade. Also, if you're looking for a trade, You want to look for a trade where the moving averages are stacked positive and price is above the 21. What I like is typically, now it didn't happen here, but I do typically like to see price above the 8 and a pullback to the 21. And that's where I would look to possibly get in. Not here, but this is a good zone to get in. You don't want to get into a trade when it's trading all the way up here, extended above the 8. You want to get in when it pulls back to the 21. That's a better price. And then it fires up from there. Now, if it breaks down and never clears any of this, then obviously you're out of the trade. You're not going to add to the trade. Then the reverse is true. So when the moving averages are stacked in the other direction, like they are here, look what happened here. This was trading above the 8. It broke down, and then it continued to break down. And as soon as price was trading below the 89, you knew the stock was in trouble. And it was. Although Roku has wild swings, you can see that this is currently, in this where my pointer is, you can see it's trading below the 89. It does come back up a little. All the moving averages are kind of bunched all together. This is not a time to be trading, at least not trading it long. You can see as it trades further lower, the moving averages are now stacked in the opposite direction. You now have the 8 at the bottom here with the 21 above the 8, the 34 above the 21, the 55 is above the 34, and the 89 is on top. So the moving averages are stacked in reverse. That's a downward trend until you see price start to break above the 21, which it does here. There's a crossover. Even though you have some congestion in here for a week or two, then it breaks above the 8. Moving averages are now stacked positive, and look what happens to the stock. It goes up from here. Okay, so that's what the moving averages can tell you. They identify trends, and you see price in relation to the moving averages. And finally, let's just take a closer examination of the 21. So let's take one more look. The red and the turquoise here are the Bollinger Bands, and which we'll get into it in another video, and the 21-day moving averages in blue. And what you'll notice, this is the VIX, this is the volatility index. Look how price stays here at the 21. It pulls away from the 21, hits the top of the Bollinger Band, and then pulls right back to the 21. This is called the mean. It gets away from the 21 and pulls right back. It's like a magnet. It pulls back up to the downside and then comes right back to the 21. It'll trade away from it and come back, away from it and come back, away from it, come back. It'll stretch all the way up here. Where does it come back? It always comes back to the mean. Always. The mean is sea level. Okay, remember the ebbs and flows? Well, the 21-day moving average is sea level and always comes back. And a lot of people can trade this, what they call reversion to the mean trading, meaning that no matter how far this extends, it will always reversion to the mean. It'll always come back to the mean. So when it stretches way out up here, this is a shorting opportunity, and you can short this until it comes back to the mean. When it pulls back away from the mean, you can go long and then ride it till it gets back up to the mean. You can even continue until it stretches up to the upper Bollinger Band and then get out, or then short it from there and come down. In other words, you can make money with reversion to the mean trading as it pulls away from the 21 and comes back. And if you remember our cycle of emotion, where the trader gets excited and they think about getting into the trade and they say, okay, I'm in. And right around here, as it's been trading up, remember this is pulling away, this is trading above the mean. They get in here and it just pulls right back. So this line here is sea level. This line right in the middle is like the 21-day moving average. Price will pull away and come back. It'll pull away and come back. So when is the best time to enter the trade? Well, if you're shorting, if you want to short this, you wait until it gets extended away from the mean and then you short it down into the mean. You can go even further. When it pulls all the way back down here away from the mean, you can then consider getting into the trade. Highest potential for earning because it's gonna trade at least back to the mean. That's reversion to the mean trading. So getting back to the chart here, you'll see the 21-day right here in the middle. This is the mean. And when you look at the exponential moving averages, where they're stacked one on top of each other, you'll see that price stays above the 8 and you want to stay in the trade. When it starts to cross over, that's when it's time to get out. That's kind of a trigger to get out. You want to have them on your chart so that you'll be able to identify the trends. Again, our new definition of an uptrend is higher highs, higher lows, and price is above the broad moving averages, those being the 50-day simple, 100-day simple, and 200 simple. And seeing the exponential moving averages stacked positive, and as long as price is above or holding the 8 as support, that's a strong trend. You want to stay in the trend. And even the 21, if it holds the 21, that's still a strong trend. As long as it doesn't challenge, as long as price doesn't challenge that 21-day. If it starts to close under the 21, then that's probably going to open the door, or could open the door to the 34 and on the way down again. This is great for daily time frames. You can put moving averages on any time frame, but the 8 and the 21 are especially good on the daily because it shows you kind of what's happening right now. So the daily is good for immediate time frame, and then next you want to see the broader view of the market and start looking at the weekly time frame and the monthly time frame. This will give you a broader indication. So here's the weekly. The weekly looks really good, except it broke down here, but it's now trading above the 8. So on a weekly basis, even though Roku looked down before, had quite a downward move, overall, this stock is trending higher. And you'll see they were stacked. They did pull back a little bit, but they're starting to realign again. So although here's the red sort of coming up. So I would say in a few days, these are going to be stacked positive. If Roku continues to move higher, you're going to see the moving averages stacked again, and any pullback to the 21 is a buying opportunity. That's it for moving averages. See you in the next video.